The market isn't crashing because investors are afraid. Investors are becoming afraid because something has already started changing beneath the surface. Right now, while millions of people are celebrating new highs, a silent shift is taking place that could leave some investors richer than they ever imagined, and others wondering how they lost everything without seeing it coming. Every great financial storm begins the same way. Not with panic, not with red numbers flashing across giant screens. It begins with confidence. The kind of confidence that convinces ordinary people they finally figured out the market. Every dip gets bought. Every rally feels unstoppable. Financial influencers promise endless gains. Television experts compete to predict even higher prices. The headlines sound almost identical every day. This time is different. But history has heard those words before. Picture an ordinary Monday morning. Coffee cups fill office desks. Traders glance at glowing monitors. Long term investors check their portfolios before heading to work. Retirement accounts continue growing. Social media celebrates another profitable week. It feels like the easiest money anyone has ever made. People who ignored investing for years suddenly open brokerage accounts. Friends begin recommending stocks at family dinners. Taxi drivers talk about artificial intelligence. College students discuss options trading. Everyone seems convinced that the future only moves in one direction. That's exactly what happened before some of history's biggest market shocks. The strange thing about financial bubbles is that they don't feel dangerous while you're inside them. They feel exciting. Every winning trade creates more confidence. Every success convinces people they're naturally gifted investors. The line between skill and luck slowly disappears. Without realizing it, people stop respecting risk. And once that happens, the market begins preparing its next lesson. At first, nobody notices the warning signs. One company misses earnings, another lowers its guidance. A few executives quietly sell shares. Interest rates remain higher than expected. Economic data becomes slightly weaker. Individually, none of these events seem important. Together, they begin telling a story that almost nobody wants to hear. But the real problem was just beginning. Deep inside the largest investment firms, conversations start changing. Portfolio managers who spent months chasing growth begin discussing protection. Analysts become more cautious with their forecasts. Risk managers quietly reduce exposure. Hedge funds start building positions that benefit if markets fall. None of this appears on the evening news. The public still sees smiling headlines while professionals begin preparing for uncertainty. This is where human psychology becomes fascinating. Most investors don't buy because prices are low. They buy because prices have already gone up. Success creates attention. Attention creates demand. Demand pushes prices even higher. The cycle feeds itself until it reaches a point where expectations become almost impossible to satisfy. What happened next shocked everyone. Artificial intelligence became the hottest investment story on earth. Companies connected to AI saw their stock prices soar. Investors poured billions into businesses they barely understood. Every conference presentation included the words AI powered. CEOs rushed to announce new strategies. Some companies genuinely transformed their industries. Others simply added fashionable buzzwords to impress investors. The market stopped asking difficult questions because excitement was easier than analysis. Money flooded everywhere. Retail investors bought aggressively. Institutions increased positions. Financial media celebrated every new record. Fear of missing out became stronger than fear of losing money. People who had never opened a balance sheet suddenly believed they could predict the future of trillion-dollar companies. Confidence reached extraordinary levels. But confidence can become dangerous when it turns into certainty. Some investors borrowed money to buy more stocks. Others used leverage for the first time. Many concentrated most of their savings into just a few popular companies. Diversification suddenly felt unnecessary. Why own 10 businesses when one superstar stock kept outperforming everything else? History has answered that question many times. Very few people listen until it's too late. Meanwhile, company executives faced enormous pressure. Wall Street no longer expected strong results, it expected perfection. Growing profits wasn't enough, they had to grow faster than before. Launching successful products wasn't enough, every launch needed to change the world. Each quarter became a performance where even tiny disappointments could erase billions in market value overnight. Then something subtle happened. The market stopped rewarding good news. Excellent earnings produced only small gains. Positive announcements barely moved prices. Investors started expecting success before it even happened. When expectations become impossible, reality often disappoints. That's when emotions begin changing. Not all at once, quietly, almost invisibly. A few investors lock in profits. Others convince themselves they're simply being cautious. Volume starts increasing. Selling pressure slowly grows. The headlines still sound optimistic, but something underneath has shifted. Nobody could have predicted how quickly that shift would spread. One unexpected economic report arrives. Inflation proves more stubborn than expected. Interest rate cuts appear less certain. Bond yields climb. The dollar strengthens. Suddenly, investors begin recalculating everything. Companies valued on future growth become harder to justify. High expectations collide with higher borrowing costs. The mathematics changes. And markets always respect mathematics eventually. Fear travels faster than optimism. One red day becomes two, two become five. Financial television invites bearish analysts back onto primetime programs. Social media timelines transform overnight. Yesterday's heroes become today's warnings. People who celebrated every rally suddenly stop checking their portfolios. Silence replaces excitement. Then comes panic. Not because businesses suddenly disappeared, not because every company became worthless, but because human beings hate uncertainty more than almost anything else. The same investor who refused to sell after doubling their money now desperately sells after losing 20%. Nothing about the business changed overnight, only emotions did. This single decision changed everything. Large institutional investors begin buying, while retail investors rush toward the exits. It's one of the oldest patterns in financial history. Professionals often accumulate assets during fear. Amateurs often accumulate assets during excitement. Neither group knows the future, but they react differently to uncertainty. The difference shapes fortunes. Imagine sitting alone late at night, staring at a portfolio that once represented years of savings. Numbers that felt permanent begin shrinking. Months of gains disappear within days. Every refresh brings another surprise. Every headline sounds worse than the last. Sleep becomes difficult. Conversations become shorter. Stress quietly follows people into work, dinner, and family gatherings. Money isn't just numbers, it's security, it's dreams, it's freedom. Watching it disappear affects far more than bank accounts. Yet beneath the panic, another story quietly unfolds. The strongest businesses continue operating. Employees still build products, customers still place orders, factories still manufacture, software still gets updated, deliveries still arrive. Real businesses don't stop functioning because stock prices fall. Markets often confuse temporary emotion with permanent value. Experienced investors understand this better than anyone. They don't ignore risk, they simply refuse to let fear make decisions for them. While crowds focus on headlines, they study balance sheets. While others panic over daily price movements, they analyze long term competitive advantages. Patience becomes their greatest asset. But patience isn't easy when everyone around you is losing confidence. Then another twist appears. Several companies report surprisingly strong earnings. Revenue exceeds expectations. Cash flow improves. Management raises future guidance. Normally, such news would ignite massive rallies. Instead, stocks barely move. The market no longer rewards good news because fear has become stronger than facts. Psychology now controls prices more than performance. That's when investors truly begin losing their minds. Some sell everything, others buy everything. Many freeze completely, unable to make any decision at all. Emotion replaces strategy. Hope replaces discipline. Regret replaces confidence. The market becomes a battlefield between fear and greed once again. History repeats itself with astonishing consistency. The dot-com bubble, the housing crisis, the financial crash, the pandemic panic. Each period felt unique while people lived through it. Each one convinced investors that normal rules no longer applied. Each one eventually reminded everyone that markets move in cycles, not straight lines. The biggest winners weren't those who predicted every crash. They were the ones who prepared for uncertainty before everyone else noticed it. Preparation rarely looks exciting, it feels boring. Diversification feels boring. Risk management feels boring. Holding cash sometimes feels boring. Ignoring social media hype feels boring. Yet those boring habits become priceless during extraordinary moments. Behind every market panic lies the same emotional battle. One voice whispers, "Sell before it's too late." Another whispers, "Hold because nothing has changed." A third says, "Buy while everyone else is afraid." Knowing which voice deserves your attention is one of the hardest skills any investor can develop. Then the headlines begin changing again. Markets stabilize, volatility slows, companies continue growing, economic data gradually improves, confidence quietly returns. People who sold at the bottom start wondering if they made a mistake. Those who stayed invested begin recovering losses. Those who bought during fear suddenly look like geniuses. Yet they weren't necessarily smarter. They simply understood one timeless truth. Markets transfer wealth from emotional decision makers to disciplined ones. That's why investing is never just about finance. It's about human behavior. Charts reflect emotion, prices reflect expectations, volatility reflects uncertainty. Every boom and every crash tells the same psychological story using different headlines. The greatest investors in history weren't perfect forecasters. They made mistakes, they experienced losses, they doubted themselves. But they built systems that prevented temporary emotions from making permanent decisions. That difference changed their lives. Somewhere today, another investor is opening a brokerage account for the very first time. Another is preparing to sell after months of fear. Another is convinced the next rally has already begun. Another believes disaster is unavoidable. Each one feels absolutely certain. Most of them cannot all be right, The market doesn't reward confidence, it rewards accuracy. And accuracy often comes from asking uncomfortable questions instead of chasing comfortable answers. When everyone agrees that stocks can only rise, caution becomes valuable. When everyone believes the future is hopeless, opportunity often begins quietly appearing. The hardest moment to stay calm is usually the moment when staying calm matters most. Investors aren't about to lose their minds because the market is broken. They're about to lose their minds because markets expose something far more unpredictable than economic data. They expose human nature. Fear can erase years of patience in a single afternoon. Greed can destroy decades of careful planning in one reckless decision. Hope can blind intelligent people. Panic can convince rational people to do irrational things. The numbers flashing across trading screens tell only half the story. The other half exists inside the minds of millions of investors making emotional decisions every second. And that's the secret most people spend their entire lives trying to understand. The greatest risk in the stock market has never been volatility. It has never been inflation. It has never been interest rates or political uncertainty. The greatest risk has always been the person staring back at you in the mirror. Because fortunes are rarely built by predicting every move the market will make. They are built by mastering the one thing the market can never control: your own mind.